Welcome back to the course Introduction to Commercial Banking and Fintech, and I hope you had sufficient background about the banking risk. Since it is a new topic, so I thought I should be spending more time on it. So let's get into credit risk and the capital risk, and we'll be trying to understand in detail. So one is the corporate default. As I mentioned, that these are the sources of the credit risk. One is the corporate default, second is the retail delinquencies, sectoral concentration, and macroeconomic downturn. So this is what here we have. Then here we have the gross non-performing assets, net NPAs and slippage and provisional coverage. And then we saw the CRAR, regulatory capital upon the risk weighted asset, that how much is the risk and how much is the capital that the bank has, which is abide by the government or the central bank. So let's think in terms of liquidity risk. So first is the liquidity coverage ratio. What do we include? So here we include the high quality liquid assets, right? So HQLA we say, and net cash outflow means how much you have lent or whatever is the purpose the money has gone out. Okay. So high quality liquid assets, which means that how much you have the loans still liquid, and how much you have the cash outflow, which means that how much you have given, how much you have the withdrawal. So this is what outflow we say, which is like you have the cash flow from asset and you have the also withdrawal. If it is a greater than 100%, then it talks about the liquidity risk. It means that the denominator is much lower, and if it is like if the numerator is higher, it means that you have the better earnings of your assets, right? So that you can think about. If it is less, then it means that you have more outflow. So this is more on the risky side, right? So higher is better, that we can always say. Then here the net stable funding ratio, which has come under Basel III mostly. So how much you have the available stable funding and require stable funding, which means that if you have deposits of 100 crore and you think that on a daily basis there is a request for 5 crore rupees from the different depositors, and also that you have money to lend, because it may happen that some of the borrowers which are a good borrower, they may be paying early but they need immediately cash. So those things also, but here it is mostly dealing with the available funding, how much you have the stable funding, mostly to counter the over withdrawal. So this is what, so long term funding as stability it says. Credit to deposit ratio, which is like total advances upon total deposits, so how much you have given and how much you have. If the numerator is lower than the advances, then you are at the leverage, right? And if it is lower, then it means that you have more deposit than advances. So this is what it implies. So liquidity strength means adequate HQLA, which means that you need to be having higher stable funding, you have the sufficient funding, and moderate CDR, which means that you may not be keeping everything in excess reserves. Of course, you will be going for advances, right? So here this is what we have, higher CDR, the tighter liquidity condition. It means that you have gone for giving more deposits than this, and this is what it implies, right? So this is what we say moderate CDR. It leads to what we call it as the liquidity strength. Then operational loss arising from internal process failures, fraud, cyber risk or anything, right? So IT outages that we have, fraudulent lending, cybercrime, misreporting or governance failures, all these things are linked. You can say a systemic risk is also attached with the operational side, may not be 100%, but yes, it shows that how distress is spread from one to another, and it can be because of this, right? So this we'll be discussing later. I'm just giving you an overview. These things will be discussed in a bit. Let's understand the major indicators of non-performing or the major risk concentrated in a bank. So these are the three ratios. So GNPA means gross NPAs upon gross advances, how much you have given and how much you have the NPAs, right? So if the denominator is higher, it is better. If the numerator is higher, it means that you are on the bankruptcy side. Net non-performing assets, which means that it is the gross NPAs minus, you can say in terms of provisions, how much you have the provision that we saw in the case of balance sheet, and net advances, that how much you have given and how much you have. So that you can see. Then here we have the coverage ratio. So this we have provision upon the gross NPAs. Slippage, how much you have the new NPAs and how much you have the beginning of the standard advances. There are studies on this, that why in a bank system or in a banking system, when we have a new shock coming in, we see that for a long period of time banking sector does not work at the optimal level. They work at a suboptimal level because of the slippage and other rules and governance, and especially if you are attached with the government banking sector, then it becomes a more rule based governance structure, and as a result you find that there are, for example, there has been a study which have found that the new bank manager, when they join the branch, they do not issue the new loans as until unless they verify all the previous account, and any new or existing customer come, they first look at their KYC standards and then they go for a lending, otherwise they may be in trouble, and that also delays further. So in this particular course, the idea is that we should be also able to understand what are the challenges and why are we referring these indicators. So I have created a slide interpreting NP indicators, and sometime we also find that when we read economic survey, any public document, these numbers will be coming, so you should not be getting confused. So with that in mind also I have created this. So stock of stress, how large is the problem, which means that gross NPAs upon gross advances. Then loss absorption capacity, how strong is this buffer, right? So this, which means that provision upon the gross NPAs. Residual net NPAs, right, which means that how much risk remains based on the provision and then gross. This we have already done. The flow of deterioration, what is coming next in terms of slippage, new NPAs upon the standard advances. So which means that high GNPA, loss absorption capacity, high slippage leads to more chances of bankruptcy. So if you have these indicators coming, this is the summary that I have written at last. So this is the summary I have written at last, that high GNPAs, low PCR, high slippage and increasing solvency rates creates the bankruptcy issue, and this is what we often get here. Now let's have the understanding about what we can learn from this. So here we have, so asset quality assessment, consider the following simplified balance sheet of a large Indian public sector bank. So here we have the gross NPAs coming of this code, gross advance of this. Gross NPAs is around 96,000 crore, right? So here we have in terms of 32 lakh crore, then 96,000 crore, and then here we have total provision 72,000 crore. Net advances, that here we have almost like you can think about 3,80,000 crore that here we have. So then here we have compute the GNPA ratio. So GNPA ratio is this is the question that I have added, that compute the GNPA ratio, compute the provision coverage ratio, and then here we have the NNPA ratio, and we have to also find out whether the bank appears stable, vulnerable from credit risk perspective, right? So here we have we are also assuming that there is no restructuring happening with the loans and there is no write-off, right? So those things we are having. So if you go by, so 96,000 upon the total advances that here we have, so it is coming out to be 3%, right? Provision coverage ratio that we mentioned, here we have the 75%, 72,000 upon 96,000. 96,000 is the gross NPAs, provision is 72,000. Right, so this is what here we have the 72,000 upon the 96,000. This is what we get in terms of gross NPAs. So this is what here we have, and net NPAs. So first I have to go for gross NPAs, which is 96,000 crore, and then here we have the total provision. So this is coming out to be 24,000 crore, and 24,000 upon the net advances, it is 80,000. So here it is 0.78. So here we have the interpretation of this, how we can interpret. So GNPA 3% looks moderate, right? So this is what here we have. The provision coverage ratio is at 75%, shows that you have a strong provisioning discipline. So this is what here we have, right? And then here we have the NNPA at 0.78%. It suggests that here we have the residual credit exposure. So this is also a good thing to note about. Then here we have the moderate GNPA, and then we have the high PCR provision coverage ratio and low NNPA. It looks, we can classify that as the good in terms of the credit coverage. So this is what we imply here. So this is what we get. So stable credit provision, which means that moderate GNPA, which is 3%. Then here we have the provision coverage ratio, which is 75%, and NNPA is 0.78. So this can be also touched upon. So this is what here we have. So it means that bank is more looking some kind of resilient. And then here we have the slippage ratio. What do we infer by? So suppose a large public sector bank reports the following for the financial year. A standard advances at the beginning of the year is around, for example, 31 lakhs 50,000 crore. So this is what here we have. And then here we have new NPAs during the year is 18,900. So compute the slippage ratio, interpret what this implies, and how can we explain whether it affects the GNPA level or not. So slippage ratio is this new NPAs upon the standard advances. So this is what here we have. So slippage is how much? It is 18,900 upon 50,000. So it is coming out to be 0.6%. This means that 0.6% of the performing loan book deteriorated into the NPAs during the year, which means that only 0.6% of the performing loan book has gone bad, otherwise it has not, and overall it looks like slippage is only minor. So this can be also considered in that way. So what is the meaning of 0.6? Because these are new topics, so I thought I should be giving you details. So it implies that there is you have very low stress. So there is a relatively low inflow of fresh stress. It also indicates improving underwriting, or you can also think about the based on the macro conditions. You can also find that there will not be much impact on the GNPA because slippage is just 0.6. Had it been 1% or 1.5 or 2%, then that would have been great. But slippage implies that if you are not able to contain your NPA, so it means that slippage today is nothing but here you have the GNPA tomorrow. So rising slippage can signal upcoming deterioration. This is what. So slippage has this literal meaning that rising slippage can signal upcoming deterioration, and it is also a leading indicator of asset quality. So slippage implies asset quality. Right, so this we have to understand. Okay. Now here we have the stress scenario. What do you have in a stress? So here we have consider the following data for the mid-sized private sector bank facing credit stress. A stress scenario we are considering. Suppose gross advances are 2,50,000 crore, and then gross NPAs are 37,500 crore, and total provisions are 1,500. Compute GNP ratio, compute the same PCR and NPA, and interpret in terms of solvency and capital risk. So we can go for, so gross GNPA ratio is how much? 37,500 upon 2,50,000. So this we can get into. So 15%, right? Then here we have the provision coverage ratio, which is around the 15,000 again upon the 37,500. So which is equivalent to 40%, you can say. So GNPA is 15%, which is like big amount, and this needs. So here we have, and then net NPA is 22,500, and you can say that it is 10%. So if I have to explain this, that what is the meaning of this, then GNPA as 15% indicates severe accumulated. Earlier in the last example we saw only 3%, but here it is 15%. It means that bank is likely to face a high credit stress, because this is what it is accumulating over a period, and this is and PCR provision credit ratio at 40%. It also indicates a weak provisioning buffer, which means that it will eat out lot of interest income of the bank. It requires high provisioning which means that in the balance sheet they will have to increase this amount, and this is like a big risk for the bank, because that money could have earned high rate of interest if they would have added to the lending basket excess reserves. NNPA at 10.6% implies high unprotected exposure. So this is what here. So integrated risk signal is this: high GNPA, low PCR, and capital vulnerability. So this is what it implies. So low provisioning magnifies the probability of capital erosion, market confidence loss, and the liquidity stress. So this is what here, because it requiring a high, here you have the weak provisioning buffer, and low provisioning it is having indication that it is going for capital erosion. Second thing, that once it comes out, then there will be market confidence of loss and liquidity stress. So this could be also linked with some of the Indian cases that we saw in case of Yes Bank and other, and this is what you can link with. So high GNPA, low PCR, it talks about the capital vulnerability, because here you have the high GNPA, but low provisioning also, that you have the high probability of capital erosion. So this all indicates the solvency risk of the bank. So if I have to go for explaining the comparative interpretation, stable versus stress profile, so you can see that the first case is the stable bank case, where GNPA is just 3%, PCR is 75%. Then here we have the net NPA is just 0.8%. What it implies? It implies that the provision coverage ratio, you can see, though the GNPA is 3%, the provision coverage ratio is 75%, which is like very good, right? And net NPA is 0.8%, which means that with low GNPA of 3%, you have the proper provisioning of the loan losses. It means that bank is reducing the credit risk to almost zero, and this will bring a lot of confidence that even though you have to put check on the GNPA, because NPA's numbers are higher, 3% is still recognizable, but you have a good backing, that's why your NNPA numbers are much less. A stress bank, you can see that you have 15% GNPA. Okay, out of that you are having coverage of only 40%, and that implies that even 15% is not, you have been able to cover, and net NNPA is 10.6%. So this is the proper example of stress bank, that how it can be. So what is the industry rule of thumb, that if somebody will ask you in interview and anywhere, what we have to answer? So GNPA below 3 to 4%, it indicates manageable stress. The provision coverage ratio above 70% suggests a strong long absorption capacity. Net NNPA below 1 to 2% generally signals limited residual credit risk, and GNPA above 10% combined with PCR below 50% signals solvency vulnerability. So this is what here we have. So integrated stability principle is this: so resilience is equal to low GNPA, high, you can say, provision to coverage ratio, and then low NNPA. These are called resilience. So bank is resilient when we have a low GNPA, high PCR plus low NNPA. So this is what here we have. And provisioning discipline and capital buffers determine long run stability. So this also we can look at. So overall, I hope you are able to get the sense of why NPA's number are always in the media. Whenever we read policy documents, whenever we read any RBI documents, they always highlight these numbers, GNPA numbers, and they become really important in that context, right? So this is where it is very important. Now there are other important accounts which we need. So these are called early warning system. So for the bank also, like for example for the economy, we have like some indicators which are like sunspots, and based on that we can consider that the economy is doing better or poor, so that we can always touch upon. So here we have a special mention account, and this has become popular in India after 2016 banking crisis, wherein earlier it was not a very routine exercise. So SMA accounts became popular after 2016 Indian banking debacle, and after that the RBI tightened the screw, and all the banks are now being told to monitor before NPA. So NPA, if we have greater than 90 days of non-payment, but before that what we can do? So there is something called days past due, DPD. Number of days interest on principal remains unpaid after the scheduled due date. So this is what here we have. RBI classification for term loans. So continuous overdue basis is this. So SMA is 0. So 1 to 30 DPD. So in CP and stress is this. Then SMA 1, it is 31 to 60 DPD. So moderate stress. SMA 2 is 61 to 90 DPD. So it is having this severe stress. So you can see. So if you are having account and if the account is not receiving payment on time, so within 30 days you this will be put into SMA 0, 1 to 30 days, which means that you are having the stress arising. So maybe you can start looking out who is the borrower and why he is not responding and why he is not paying. Then 31 to 60 days moderate stress, it means that even if you are not able to identify, relocate and get in touch and you are trying to find out why, what happened, then you have the moderate stress, 31 to 60 days that we often count. And then here we have SMA 2, 61 to 90 days. So it is having the severe stress, which means that 61 to 90 days is having, like if even after 60 days you are not able to identify the borrower. So I think you have to believe that the default risk is much higher. And if the NPA, if the days past due is greater than 90 days, then you declare that NPA, right. So SMA buckets provide a forward looking stress, a pipeline before formal NPA recognition, and SMA 2 represents almost like default risk, right. Default so SMA 2 is considered more vulnerable for the bank. So if you have like account here, SMA 0 had 30 account, for example, which were non-responsive, right. So it is not NPA. So 30 accounts there, then you traced out, then you found that you have a 20 account, 10 people responded, and then they are able to repay, and then you are left with only 10, which is like absconding, no phone call, no traceability, and somewhere you find that it has become the case of adverse selection. Then in that case this will become the NPAs if you are not able to make provision. So this is what here we have. Now here we have the one more concept, which is measuring the deterioration and recovery, how you can. So credit risk evolve through the transitions across buckets. So what are those? So here we have the roll rate, so deterioration probability, SMA 2 accounts becoming NPAs divided by SMA 2 accounts in the previous period, right. So it means that suppose if you have a 30 account here and here you have a 10 account, right. So it means that your numbers are going to be lower. But if it is like here you have a 30 and here also you have a 30, it means that all those were in the previous period now into the SMA 2 accounts becoming NPA. So it means that you have the risk very high, right. So this is what. So high RR2N signals near term GNPA increase, which means that you are not able to trace out the borrower or you are not able to regularize the SMA 2 accounts, and it is soon to become NPA. So this is what we have. Cure rate, we call it at recovery probability. SMA accounts regularized, that you are not able to trace out, but now you are able to trace out and you have regularized. So that account is now liquid and that account is receiving money and EMI payments are receiving on time upon the total SMA accounts, right. So if the SMA accounts are lower, your cure rate is higher, and if you are able to regularize more SMA accounts, it means that you are doing better and you will not have that much risk, right. So this is what you have. High cure rate offsets stress migration, and this is what you have. Early warning rule will be what? Early warning rule will be high SMA 2 stock upon high RR2N. So this is what here we have the roll rate. So it is what here we have the impending NPA search. So this is what here we get. So if RR2 is higher, which means that SMA 2 account becoming NPA is much higher, then it and first of all, the high SMA 2 stock itself is a big concern, that how come it was not traced when it was in SMA 0 and how come it was not traced when it was in SMA 1 and now it has come to SMA 2. So that is bound to get implemented. Stock versus flow in credit risk modeling. So this is also one important aspect that we often look upon. So credit deterioration must be analyzed through two complementary lenses. One is the stock perspective, which means the level of stress. So SMA stock ratio could be like SMA 0 plus SMA 1 plus SMA 2 upon the total advances. So this is what here we have, which means that it measures basically how much you have the pipelines of the loans that here we have. So this is what we get, the pipelines of the loan. Flow perspective would be like speed of deterioration. What is the speed of, so new NPAs during this period, how many SMA 2 were converted into the NPA. So this is what here we have. And standard advances beginning, how much fresh loan you have given, how much your advances given. It also measures the performing loans turn not non-performing. Like for example, if this is higher and this is lower, then it means that slippage ratio is much lower. If this is lower and this is higher, it means that you are also getting into, you have a high rate of NPAs turning and you have a low of the fresh. Or if you have a both having one, it means that it is 1 to 1. One account you generate for loan, but one you have turning into NPA. So high stock of this we have the level of high stock of SMA, you can say, right. High flow, which is related with the slippage, right. How many are turning into NPAs, it leads to what we have, the unbearable credit risk. So this is what we often mention here, right. Now how and in what way we can mention. So SMA buckets from deterioration goes like this. This is what is the normal channel. SMA 0, it will be first, SMA 1, SMA 2, and it leads to NPAs, right. So this is what we have. Now let's get into the understanding about the pipeline forecasting, what it implies here. So we can assume that SMA 2 stock is suppose 1200 crore. A roll rate is suppose we are assuming that 25%. Expected near term NPA formation, so here it will be 0.2. So it means NPA formation is going to be around 300 crore rupees is going to be NPA. What it measures, that it helps you understand the GNPA increase, what rate it will increase. You can go for advanced capital provisioning and the capital planning, and also helps the supervisor to manage the stress. So pipeline analysis is a proper case of the early warning signals. So with this, I think we are able to understand that what we mean by the overall the credit risk at the micro level, and in this the basic understanding is that what we understood, what the new thing is that when we are having the SMA2, SMA2 is like you have more than 80% of chance of becoming NPAs. And overall learning of this particular lecture has been that can we understand the credit risk from the performance of the advances, the micro level management or monitoring. Can we also link all these default related indicators with early warning signal? Can we create a stock flow scenario? Can we monitor the bank efficiently? Can we also think about the high provisioning? Can we understand the level of stress? All these things we covered in this particular lecture. In the next lecture, we will be focusing on mostly on the side of the write-off and other regulations that we need, and also we will be trying to summarize in a better way what we need for the banking sector risk. With this, I am stopping it here. I hope you are enjoying the course. Thank you. Thanks a lot for your attention.